Our company, I'm Zach Morris.
Mohammed Castle.
I'm Jeremy Garza, and today we're going to talk about our simulation findings.
Our mission at Company F is to truly satisfy all of our customers' needs to the highest possible rate. It is our main goal to take care of our customers to the highest possible satisfaction. We here at Company F thank you for all your patience, and we truly are happy to announce our stock repurchase. As a business, we are revamping our product marketing sector, and we believe our investors will be pleased with our results. We now envision Company F truly becoming the leader in drone and AV camera market, and now on pace to obtain that title. Our pest analysis. We use political values to decide which countries we should focus on and which companies we should avoid. We then looked at the economic activities that was going on currently in these countries. The economic activity that goes on in this country has a direct effect on the local markets. We also took a deep dive into our social and political factors. For example, in China, it is illegal for citizens to buy drones. Therefore, we focused on selling drones to the government and people in China that could purchase drones. Finally, we looked at the country's technology factors in those countries. Our SWOT. Our biggest strength was that in the industry, we were high in extra performance on cameras. Also, our operating profits were over 200% in North America and Asia. Our biggest weakness was our low image rating due to taking care of our customers instead of focusing more on charity events, which is also our largest opportunity. We could have increased our CSI by focusing more on charity events versus our stockholders. And our biggest threat was our high operating costs due to operating in foreign countries. Our competitive advantage. Our competitive advantage is that our return on equity was over our expectation of 50%, and our ROE was 79.9%, while we were able to keep A+ rating.
For our strategy, we used a mix. We used both product and price differentiation, and for our international strategy, it varied from time to time. We started in trying to accompany to all the markets we had between Asia, Africa, North America, and Europe, but later on focused more on North America and Europe. Next. The issues that we had with both strategies is in the earlier years we used more of a price differentiation. We wanted to be more affordable. We lowered our operation costs when it came to drones and cameras, and we tried to give more discounts, be more friendly to our customers, and didn't take out as much debt, which later affected us. Overall financials were good, but we felt that we had more of a potential to grow, so we decided to change our strategy to create more value, which later on in later years we changed to a product differentiation strategy where we did major drone upgrades, major camera upgrades, and to sustain these incurred costs and improvements, we took out more debt, we raised our prices, we lowered our discounts, and we gave less dividends for a short period of time. And then we also increased promotional advertisement costs to get more people to look at our newer products. Eventually, this led to higher revenues, higher margins, and more profits, and which allowed us to make bigger stock buybacks and give more dividends again to please our shareholders, increase our wages, and eventually give more to the society around us and increase our social responsibility. Our competitive dynamics, because we weren't at the top of our industry for most of the time, that no one really reacted to our strategies, but we reacted to the top company strategies.
Metrics we decided to focus on besides ROE and our profits were starting with our PQ rating. So a company whose drones have PQ rating above the industry average has an important competitive advantage over rivals. With that being said, as Company F, we desired for our products to be high quality with high level of performance features. As we progressed from year 5, we saw some fluctuations in our PQ rating, but relatively we were able to increase it at the end. With that in mind, we were able to increase our brand reputation over both categories of products, our cameras and our drones. Another key metric we decided to focus on was our credit rating. We didn't want to overextend our debt, and we actually issued a lot of shares instead. So our debt to equity rating was around 30 to 70% for relatively most of our simulation. From then on, we decided our current ratio was another aspect we wanted to focus on to keep around the industry average. So we wanted to minimize our risk of default so well. That being just because we might have had some calculation errors or some typos in it, and we didn't receive points for our credit rating or our image rating. So we set it at a level of 5 when it was more along a level of 60 to 70%. And with that, our first 3-year plan didn't go very well at all. So once we got our second one, we decided to focus on our ROE, meeting that expectations, and which we were able to achieve and overachieve. So our targets were set at a perfect level, and we were able to reach them. So what was actually useful about the simulation? So we took into account this, the management process, and we were able to not only take it from the book, but actually implement it in a real life situation where we were able to collaborate with our group members and create a company that we envisioned to be successful. So that was done differently as a company and throughout the whole simulation. So our image rating was really poor throughout the whole simulation, which was due to the fact that we decided to focus on our shareholders and investors throughout, which we were able to achieve a high ROE as we explained earlier. Like I said before, we were able to keep it at a ratio of about 30 to 70% for debt to equity, which was a good strategy. But in year 14, we actually flipped that, and our debt was all the way up to 70% and 30% equity, which we're at a high risk for default. With that being said, if our simulation continued longer than year 14 and year 15, I think our long-term strategy would have been proper. So along with what else we could have done differently, our international strategy, we didn't take advantage of our location, our headquarters in Taiwan, as we moved all of our sales to North America and Europe. So that was one thing that we could have focused more on our domestic market. So we had high delivery and marketing costs, for our drones and our cameras throughout all of our segments, in our North America segment, Asia segment, Latin America segments, and so forth. So that was one thing we wanted to change, that we could have changed if we'd done the simulation properly. So we also had a dividend payout that was frequently just changed, or we didn't have a payout at all. So investors really like a steady dividend, and I wish we would have been able to achieve a steady dividend instead of paying an 80% dividend out and or no dividend at all. As for our pricing, we overpriced our drones compared to the industry averages, and that was a factor that we wanted to achieve profits, but it was kind of at a minus to all of the features we added, and we should have added more models instead of too many features to our drones. And our market share, because of this, we weren't able to capture a strong market share in our industry.
Yeah, thank you for listening to our presentation. We really enjoyed the simulation, and it helped us a lot. Thank you.
Thank you.